Good afternoon. Today we're asking, are you losing money because you're not pricing right? I'm joined by Graham Potts, Chartered Accountant and Managing Director, Chartered Accounting firm Wessex Commercial. With an eye for numbers and years of hands-on business and pricing experience in various industries, Graham is great at looking at ways to improve margins, profit and cash. If you've got any questions as we go through today, pop them in the chat and we'll try and pick them up as we go. So let's get straight in, Graham. What do you mean when you say businesses could be losing money because they're not pricing right?
Yeah, thanks, Linda, and welcome everybody. Pricing is an art form and is very dependent on market conditions and your ability to service that market. When costs go up, the natural reaction is to say, I need to increase prices, but is this correct? Or is it possible? You know, you might be on long-term contracts or whatever. And it's definitely not a one size fits all, as in you don't price the same way for everything. Mm-hmm. It's looking at prices across different services, different products, different customer groups, different markets, you know, depends on volumes. And then it's also how you allocate, and do you understand what direct costs and what overheads really should be allocated to what part of that sort of breakdown.
Yeah. So what do you want to cover today, Graham?
Three main topics, please. Understanding the normal way to price, understanding what you should consider when pricing, and what else do you need to consider that may mean you don't need to increase all types of pricing, or you do it differently. It may be very variable.
Okay. Can you start off by explaining the normal way to price then?
Yeah, the normal way, as most business owners do, is you add a set percentage markup to your estimated direct costs, which should give you should be enough to cover your overhead and give you a profit. Mm-hmm. And at some stage, often compare this to the market rate, which can mean them, changing that markup percentage.
Okay, that sounds fairly sensible. Are there any issues with that approach?
Well, yes. Obviously, market price fluctuates depending on supply and demand, and we've been in a hell of an interesting period, shall I put it, where you don't know when you can get supply, how much it's going to cost, etc. So you have to keep on reviewing market rates, and you have to look at where you're pricing, because you could be pricing too high or you could be pricing too low. Obviously, if you're pricing too high, then you lose the work. If you're pricing too low, you're leaving money on the table. So you must regularly review competitors' pricing, including secret shopper where possible. That's getting someone to find out what the price is that's maybe not connected to your business, so it doesn't come up. But that should be comparing competitors that are in your type of market, not just, what can I say, competitors that are your value. Say, for instance, you're value added, you're really premium product. You don't compare that to someone that's low value or vice versa.
Yeah.
And also, you should be, this is very rare that business do it, should be reviewing how your pricing compares to your accounts, your management accounts. You should be looking to see that you've priced correctly, or maybe you've got operational issues and you're losing money through that.
Okay. So it sounds to me like checking that what you think your pricing is reflected in your accounts.
Yeah, that is very important, which not a lot of businesses do.
So tell me about the things that you should consider when pricing.
Okay, well, simply, you start with your direct costs. So you build up your price. This is the direct costs, the cost of the product, or to make the product or provide the service. We've discussed in previous LinkedIn Lives the difference between direct and indirect costs. So I'm not going to go through that now. But to give you an example, a machinist would be a direct cost, whilst a salesperson would be indirect. There you are. You've got it up, the example on the board. So direct costs includes electrician, machinist, delivery driver, materials used to make a product, equipment hire, etc. Indirect are, as you've got there, the salesperson, bookkeeper, materials, consumables for your own property, not ones that you sell on, but just for your own property, etc. Now, one thing to make sure that with your direct costs with machinists, your labor, electrician, scaffolder, whatever it is, make sure you add all the associated costs. Now, the associated costs, people will know employees' national insurance, pension, benefits, but don't forget holiday, because these people, if you've got someone, they're going to have holiday and you've got to price that in, that should be an additional cost. And also downtime, because you're never going to be 100%. What's the word? I can't think of it, Linda.
Productive.
That's it. Yeah. Productive. So you may find you've got some downtime there. So make sure you add that in as well.
Yeah.
But once you know the direct cost of your product or service, then you look at your overheads, and then you work out, sort of what. Sorry, I've lost my train.
That's all right. Yeah. You once you've got those, you've got your direct costs and you've got your overheads. What's the next step?
Look at anticipated volumes.
Yeah.
So you look at what your volume is, is going to be to produce the product or supply the service, along with your capacity. Just don't forget your capacity to cope with that volume. We've all had capacity issues. It's been well documented in the last, sort of year and a half.
Yeah.
Often businesses look at the previous year's volume and adjust for market conditions. But if you do that, make sure you do adjust to say, where's it going? And often it can be just every 2 or 3 months it changes. So don't, price like thinking this is going to be it for a year. We've had periods where the prices have been stepped up every month, every week. Price, I've known people that have only held their prices, like electricity market. It only held it for a couple of hours when it was going through a crazy time in October. So be very careful at times with supply and demand when it's changing massively.
And I think you've got another example to talk through, Graham.
Yeah, I'll try and keep this as simple as possible, but it can get complicated. But let's take an example where you've got sales of 1.3 million. Your direct costs, the ones we've just been through, were 800,000. So your gross profit is 500,000. That's giving you a percentage on sales. So your gross profit percentage is 38.46%. So that's the 500,000 divided by 1.3 million. Your overhead at the moment is 400,000. Now, the 400,000 is not divided by sales because you're adding it when you're pricing, you're adding it on as a markup. So it's actually a price on the direct cost. So that comes as 50%. And in this example, your sales percentage, what you're adding on, it's 7.9%, 6%. Now, there's a couple words of warning with this. The first one is that often in accounts, people don't always split their direct costs and overheads correctly. I've seen it so many times where, like, for instance, labor has not been split between direct costs and admin costs. So do make sure that they are split. The other word of warning is a lot of businesses have take dividends and they what they call it, it's a salary sacrifice. So you pay yourself a minimum salary, 12,600 a year at current rates, and then you have a dividend. Now that dividend comes after profits. And I've seen so many businesses that forget about this, but you should add that into your overheads as a cost because it really is a salary cost. So the dividends plus the adding up the corporation tax thereon should be in there. So your net profit is actual true profit. Otherwise, you could find you're breaking even or losing. And you also need to, obviously, as I said before, you need to compare this with your regular management accounts.
Yes. So that's the sort of normal way to price. What other things do people need to consider when they're reviewing their pricing, Graham?
Type of customers you supply, are they price orientated or are they value added based? Because there's a massive difference in those type of customers in different markets. The future supply demand curve, I keep on going about in your marketplace. It went crazy recently over the last 18 months. It's settled down a little bit now, but it might actually come where, whereas we've been in a position where we've had excess demand, we might get to a position very soon, and I'll certainly see it sometime in 2023, depending on the type of market you're in, that's going to mean that actually prices might come down. You may not see that, it may not be an inflation, but it's the supply and demand. And if people start to lose work and they haven't got enough work, they go crazy with prices and they cut it down. They don't think. So you've got to be a bit careful and a bit smarter about it.
Yeah.
So regularly compare your competitors' pricing, and you to understand that and compare it to your customers' requirements. What are they actually after? Can you change, what they want, etc. Your costings, you've basically got to be looking at where are we going, because when you're pricing short term, it's quite easy. You get the prices, but when you're pricing longer term, how is that going to affect it with where the prices go, the supply and demand? Now, everybody's been caught out. No one knew that everything. But just try and keep it regular. Just regular looking at how you're pricing against your accounts, etc. What's happening going in the market? What's happening going forward? Understanding size of order, because what people don't often understand is that when you're pricing, if you're pricing something and you're selling something for £100, say, you might be winning quite a lot of work. But when you sell 10,000 of those £100, you'll be in a different there'll be a lot of competition. In which case, the margin, you may have to sell those units at £90 or £80. So the size of order comes in, but then look at time pressures. Have you got to can you get that done? I keep on saying about capacity. What about currency fluctuations? Because currency has been all over the place in the last 18 months. But look at what you're getting into. Is there any guarantees, financing costs, payment terms? And also look at your customers, because you could have one customer you might have exactly the same type of customer, same product, same service, everything's the same. But this customer up here doesn't pay on time and causes lots of hassles, is always moaning and takes up so much time. And this customer just pays. So the pricing shouldn't be the same. This customer needs to be charged out more. And if you lose it, and think about time, have a look on your basis. But those sort of customers you don't want, the ones they take up your time. Think time is money. Absolutely. And then you look at what profit you want, what sort of level and what's in the market. In good times, the profit level, 20, 30% doesn't matter. Just name your price sometimes. In bad times, you might actually have to go below cost to keep your people employed. And then you have to look at whether you cut back, etc. So there's so much you've got to look at with pricing.
Yeah. Can you give us an example, Graham, of how you've helped a business with the pricing?
Yes. We had a new client come on board wanting us to do a business review. And they're growing fast, but we're now losing money. So they asked us to look at the accounts and the pricing and, what they should do. This was in the maintenance market. And they were struggling to get good quality engineers. This is still the case at the moment. So we looked at various types of pricing, and we broke the business down into new projects. And when they got the project, because they took the project on, then it will go into maintenance. And then there was call outs, when something went wrong. So you had the regular maintenance and unplanned maintenance. We got them to compare prices with competitors, and resulted in that we saw that they were about 10% below on new projects, roughly, and 20% below on actually the maintenance, because the new projects might be charging 5,000, but on a maintenance it was say 300. In which case they could actually put the price up more, but on the new project they couldn't, because people were judging on the new project more than they were on the maintenance. But then we said, but look at this, how do you price your call outs? And it was one charge, but the call outs could be 5 minutes away or an hour away. Well, the one that's an hour away, if it's unplanned, that takes up a lot more hassle, time. It's an hour there, an hour back. It's the mileage and everything. That should be priced more. You should price more on unplanned maintenance. And so we put in a sort of variable pricing structure depending on call outs. Again, people didn't see this when you're putting the new price in. They weren't so worried about that. But the further you're away from a base of an engineer or the actual base of the office, the more it cost. So you might be adding 10% on, sort of local, but it was more like 30% maybe an hour away. And that basically helped them. And then we looked at the route maintenance, how they were going through, because they were just too much reactionary. So we tried to make it back more planned, so that actually you could actually cut out lost time for traveling, etc.
Yeah, that makes sense. And what differences did those changes make?
These changes were introduced over a 6 to 9 month period, but within 6 months they were back into profit, because you couldn't just they had contracts that were lined up for a year. So this was sort of doing it regularly at regular price of reviews. But the client's back into profits now.
Fantastic. So what do business owners need to do now in terms of their pricing?
Well, I'm always saying how vital it is that business owners understand their numbers. And this includes how to price profitably and how this matches to a profit and loss account. And if you don't know, find someone who can help you, because it's key to your business success and survival.
Yeah.
This is especially important with recent volatility, where prices have risen too fast. And, there's going to be a time when actually it's going to fall the other way. And you're going to have oversupply, sorry. And that will happen with recession, and people are like sheep and it just follows. So just try and be ahead of the game.
Mm-hmm.
You need to look at the things can go wrong, such as price increases with your suppliers, currency movements. Obviously, if you're very dependent on dollar, euro, or whatever, what's that going to go and do? Can you forward cover? And basically look at your supply chain as well. Make sure that actually you've got a decent contract. You can negotiate decent terms with your suppliers. You need to look at your accounting system. Yeah, we recommend Xero, but with the right support, you need to have regular management accounts that's broken down into chunks for your direct costs to understand where you're making money and where you're not, and maybe allocating overhead. Because in today's changing world, you just need to see those margins can change so fast against what you planned. You just don't know. Look at other ways to increase your margins. For instance, negotiating better prices, delivery times, stock holdings with suppliers, maybe on seller return, etc. There are so many different things that you should be looking at. And unfortunately, business owners, basically one thing they haven't got is time. So if you haven't got time, help you to do this properly and do this regularly. And in such a changing, uncertain world, business owners certainly need good management information and support to help them make the right decisions for them and for their business. Because we're going into a period now where, especially business growing fast, there's going to be less demand. In which case, you could suddenly think, "Oh, I've been doing great," and then straight down, not doing so well, and it will happen fast. So please get help way before things go too far wrong. Otherwise, you won't get help.
Yeah. If those issues concern you, resonate with you, and you want to start that conversation, drop us an email to chatwithgraham@wessexcommercial.com, and we'll set up a one-to-one with you and Graham. And
I can just say that's no obligation, no free, no, it's free of charge. Half an hour, I would talk to you. Yeah. And then we fix price everything, so there's no surprises with us.
Absolutely.
Sorry to interrupt, Linda.
Not at all. And because it's such an important topic, we're going to continue the theme looking at some real life pricing examples, and that's coming up on Monday, the 6th of February at 12:30. So we'll look forward to seeing you then. Thanks very much, everyone, for joining us today, and we'll see you next time.
Thank you.
Thanks.
Bye.